Hello and welcome back to another installment of Daily Day Trades YouTube. Today we're going to go over what is probably the most important topic in trading, and that is managing risk. You'll hear all the time that you need to have a plan before opening a trade, but no one really explains how to set up that plan, and it can be really tough to do so and know when you're making a mistake. There's really no way to double check whether or not your plan is a sustainable strategy, so it could be just losing money and you don't even know that you're screwing up. I'm going to lay out a few ways to start planning better and how those plans can help you make money. When it comes down to it, that's the main goal, right? Making more money. In order to do that, we really only need to lose less money. As long as our gains are more than our losses, we let compounding interest take over and boom, you're a billionaire by Thursday. Maybe not, but at least you won't be broke. It sounds very simple, but there are countless ways to screw this up, so we're just going to go over the basics and get more analytical as we go on. In this hypothetical, we're going to make a swing trade on Disney, but the same mindset would work with shorter or longer term trades. We think this setup looks good, we're ready to buy in. What's the plan? First, we have to think about the stop loss. How much are you willing to lose on this trade, and at what point is it clear that the trade is no longer working? There are 1,000,001 ways to come up with this number, but we're just going to base ours on the current and past volatility of the stock. We've got some pretty significant movement here. So we got a high way up here at 118. We have a low here at 90, another low here at 84. Right now, we're just eyeballing this to get more of a qualitative picture of the price and our expectations for this trade. In a perfect world, we want to see it get all the way up here, go crazy, and we'll make 100% or whatever. Chances are that's not going to happen though, so we're going to concentrate on a shorter time frame because we don't want to be holding this trade for, 6 months or 3 years. Judging by this, we think that when it breaks out of this consolidation on the downside, then that would probably be a good time to get out of the trade before it starts another downtrend. We can look at how much that is. In this case, it's about $2.57 or slightly less than 3% loss. Now that we've determined our stop loss, we have to find some multiple of that stop loss that's going to be a reasonable place to take profits. That multiple is called the risk-reward ratio, and it's very important. You can't just have a take profit that's the same distance away as your stop loss. Let's say that we chose $2.57 for our take profit as well. Then your risk-reward ratio is only 1-to-1, and you really don't want that. There's not much room there to make money, especially if you're not trading at a very high percentage of success rate. Let's go with a risk-reward ratio of 2, and I know I'm going a little bit fast here, but we're going to backtrack and go through how we get to these numbers in a second. Alright, so we want the stock to get here. If it gets here, we consider that a successful trade. Our stop loss is 2.59%, our take profit is 5.38%, that's a solid 2-to-1, there we go, it's set. Now we buy the stock, set the orders, and carry on with our day and hope that it hits the higher one. That sounds good in theory, but this is just a reasonable way to set this up. You can screw this up very easily. Let's see what happens if we make our stop loss down here at a little under 10%. Now for our take profit, in order to get a 2 risk-reward ratio, we have to make 20%, which is way up here, and this could take a very long time, not to mention it could stay in this range for a long time as well. So why would we let it get down this low? Ideally, we wouldn't, because we're stuck at this point. We don't want to lose 10% on this trade, and we probably know deep down that 20% is a long way away, and that'll probably take a long time. You also can't put your stop loss really tight. Let's say we're going to sell it if it goes down 1%. Well, it could very easily go down 1% and just jump right back up. 1% is not very much for this. As you can see on the previous day, it moved 1.53. So you could buy this and just intraday, it'll sell out. And by the end of that day, who knows, it could be way up here. That's why we were just looking at the general volatility of it at the start. We have this candle here that does about 3.5%. That looks like about the maximum that it'll do intraday, unless there's some sort of catalyst that's going to move it a lot more, like an earnings report or something like that. In summary, we don't want it to sell on a false negative, i.e. when it drops down just a little bit and it's not out of our trend yet. And we also don't want to hold on to it when it goes down way too far, when the trade's basically already lost and all we're doing is staying stuck in the same trade for a longer period of time. That's why we chose this number here. It's reasonable. We would break out of the consolidation. We say, okay, that's it, that's gone. And we chose the take profit up here once it breaks out of this range, but that doesn't have to be a take profit for the entire trade. This could be just selling half of the trade. All it is a point where we confirm, okay, yes, we were right. It is time to take some of this money and put it elsewhere. Just a quick note, if you don't know how to set a stop loss or a take profit order, Google your brokerage and then how to blank, and it'll pop up. It's really simple. I'm not going to go over every single brokerage on here, but it's easy to figure out. Airbnb is not a crazy volatility stocks, and I do trade a lot of things that would be considered highly sketchy, but I do it with a reasonable sum of money, and I do it with very, very strict risk tolerances. Here's one of the dicey ones that I got into the other day when it was having a big day back here. We picked it up here intraday because the chart looked good momentum, everything, decided to swing it. But since this is so volatile, we had to set a stop loss that was something like 10% or so, maybe even more, because there was a decent chance that it was just going to open 10% lower the next morning, and I didn't necessarily want to sell it then. The tricky part is when you have a stop loss that's that far from your cost basis, you're going to have to make that money up somewhere when you're managing the risk on the upside. What I ended up doing, and you can kind of use this strategy yourself, is I sold about a third of it at 18%. I chose that number because the remaining shares still have that stop loss on it, and the profits that I took at 18% would cover the amount that the remaining shares would lose when they hit the stop loss, if that were to happen. As you can see, it hasn't really gone below our buy-in price very much, so it hasn't hit the stop loss yet. If it does, we're just going to break even on that trade. If it keeps going up, then that's awesome. We've already created a risk-free trade here, and we can sell more as it goes up or find a new price target to put here. Personally, right now, I don't have a set plan for this, but the plan that I did have has already worked. So now I can let it run out and go for a really big play if that's what I want to do. It's important to note that this is not possible unless you take profits up here. If you're just sitting here watching this and your entire position is still in there, then you're still leaving yourself at risk to lose your 15 or 10%, whatever your stop loss is. I have zero risk now as long as I stick to that number on the downside. Getting those big plays is not about picking the right trade just one time. It's about setting yourself up to have those come in really, really often. That's how I end up with all these insane trades, and it's like, well, you know, how did you do that? You must be risking all your money, this and this and that. Well, no, I'm putting myself in a position where I can risk it without really putting myself into a bad position where I could get really hurt from those losses. A lot of the times my biggest plays are just on trades that are already free. I've already taken so many profits that even if I lost all of the money from the remaining shares or contracts, I still come out green on the entire trade, so I can hold it as long as I want, do whatever crazy stuff I want to do, and that's when you start getting those 500% plays or crazy stuff like that. So let's summarize what we have so far. Don't pick a stop loss that is too close or too far from the initial price, or you're going to get stuck for a long time. Make sure your risk reward, or the amount you're willing to lose versus the amount you will gain, is over 1.5. So if your stop loss is going to be at 10%, your take profit better be at least 15%, and make sure that the stock can actually get to that price. Don't pick something that's super unreasonable. You can make much more money just being consistently successful with this. We also learned that it's good to sell part to pay for possible losses in the future. Now, these risk reward ratios are one of the most important things with trading, because if you have too low of a ratio, you're screwed. If you have too high of a ratio, you're probably not going to hit that trade very often. And if you don't hit it often enough, then your win percentage is going to be very, very low, and those wins might not make up for all of the losses. AKA, you will not make any money, and that is what we're trying to avoid here. When you're investing in something short term, you want to get your money back as fast as possible with as much profit as possible, and that's your only goal. I applied these risk reward ratios when I was determining how expensive to make the trade alerts, which is also why there's a 30-day free trial at the start. So there's no risk in signing up. You don't have to take any of the trades or listen to anything that I say. And then after that, it's only $9 a month. So how do you get your $9 back? Well, you have to find something within all of the swing trades, all of the short-term volatility, high risk, high reward option trades. Maybe this will be useful to you. Maybe something in the watch list leads you to a trade. Whatever it is, you have to be able to justify spending that $9 that month. And for some people, that's been very, very easy. They'll pay for like a few decades of trade alerts with one trade. Some people don't have as much money, but still a $100 swing trade, 9%, we do that all the time. This week there was that one for 18%, then there was one for 50% in one night, and not to mention the option trades and stuff. So I set up the alerts as an investment. If you don't think you can get that $9 worth of value, then cancel during the free trial, all good with me. But I tried to make it a no-brainer because I don't want people who might not necessarily have as much money not be able to afford it. I don't think that's really fair. Either way, if you want to get those live trades every single day, there is a link in the description of this video that goes to the free trial where you can sign up and also see all the details. Once again, there will be multiple parts to this video, so make sure you subscribe as we get more and more in detail. We can go very far with this topic. And if you liked the video, of course, like the video. That's all I got for today. I'll be posting some swing trade ideas tomorrow.